so you make $50,000 a year. What business can you actually afford to buy if you have a somewhat normal job? I'm going to run the math real quick for you. To make this concrete, we're going to follow three different buyers. Someone in their early career, someone in senior management or middle of their career, and someone in the top 5%. I'll plug in their numbers into the same affordability calculator that I use with clients and then map out the exact business each could realistically buy today. And I can talk from experience because I've helped people buy and sell over $100 million worth of digital businesses in the last handful of years alone. So that's literally all I do, buy and sell companies. And by the end of this video, you'll know precisely what you can afford and then how to get started in your acquisition journey. So before we jump into those different avatars, let me show you the calculator I built here. So this first calculator on the first tab tells you exactly how much you can afford to pay for a business if you're using 5% cash down, which is the minimum amount of cash down you can use in an SBA-backed loan program. So you can see here, there's 5% down, 5% seller note. That gives you the 10% required equity injection. If you're buying a company with $242,000 in profits, the most you can afford to pay for that company would be $1 million at a 4.13 multiple. If you go to the second tab, this tells you exactly how much money a business would make with the amount you want to pay for it and the amount of cash you have to put down. So in this example that's set up here, if you're buying a $500,000 business that's making $177,000 a year and you want to put down $27,000 and you want to have a seller note for $27,000, then that business will make about $101,000 after you pay the debt service on it. So with $27,000 out of pocket, you can buy a $500,000 business that after you pay the bank loan, you'll be pocketing $100,000 a year. And then when that bank loan is paid off, that will jump to $177,000 a year if the company doesn't grow. So it's a really fantastic program to be able to acquire businesses and quality businesses with very little cash down. Okay, so let's jump back into those avatars. So the first avatar is the early career buyer. And a lot of these guys like to look at these very small deals that are 50 grand, $100,000 because they look beginner friendly. They seem that they have very little risk because they're so small, but in actuality, they're the most risky business you can acquire. They have sometimes like one product or two products, one supplier, one traffic source, the owner's doing all the work, and it's just not a quality business because one issue can wipe that entire company out. Larger businesses have more customers, more experienced staff, systems, real data, which is why banks trust those types of companies more, and they tend to avoid lending on deals under $500,000. So your best bet is to save up the money to afford to buy a $500,000 company or more and use an SBA loan program to do it. So let's say you're in that bucket of that first avatar, you're making $75,000 a year, you're taking home maybe 60 grand. You could potentially save $25,000 in a year if you really tried. SBA leverage would turn about 2 years of savings into a $500,000 acquisition. Let's take a look how. So you can see here this representation of a $75,000 salary tab. A purchase price of $500,000 requires a $27,000 cash layout. Now, the lenders will require that you have a little bit of cash cushion in your bank account. So just factor that in. They'll typically want you to have another 5% in cash savings in your account to keep in case things go sideways. So an outlay of $27,000, you could buy a $500,000 company if you structure the deal where the seller would give you a $27,000 seller note. And so you can see here, a typical market size deal would give you about $177,000 in profit at a 2.82 multiple. And after the debt service, you would be pocketing about $100,000 a year. Now, this is a smaller business, but still at that $500,000 threshold where I consider businesses to start becoming more quality businesses. And you can probably run this simultaneous to running your own, having your job or whatever else you're doing. So probably doesn't take a lot of time, and you can do this while saving up money and building your nest egg from both your salary and from buying this business. Now, let me show you what happens when the income level rises. And let's jump into Avatar 2. Now you're a senior manager or higher up on the food chain at work. You're making 150 grand, maybe taking home $120. You could save potentially $35,000 to $50,000 in a year. With the SBA plus 5% seller financing, you only need to bring about $45,000 to the table. Plus, remember, you need the other $45,000 in post-closing liquidity, and that could unlock an $850,000 acquisition. Your cash flow would be about $281,000 a year. Your loan payment about $120, and then your profit after the loan payment would be about $150,000 $100,000, which is almost the same as the salary from your job. And the affordability calculator here shows you exactly how you can accomplish that. So let's take a look at that second tab here. So here's the numbers. Purchase price $850,000, $45,000 in cash down, $45,000 seller note at a 3 multiple, which is about industry norms for a company this size. This company would kick off about $281,000 in profits, and after your debt service, you pocket $151,000. Not a bad deal with $45,000 out of pocket. The affordability calculator lets you know exactly how big you can safely go. Now let's move to the higher income buyer, because this is where we can finally talk about scale and why bigger businesses are actually safer businesses to acquire. Now, Avatar 3 is the high income buyer. They have 300 to 500,000 salary plus, take homes at least 220 grand. And if you're in this bucket, you can probably save $80 to $100,000 a year if you really try. That opens the door up to $1 million plus acquisition. So let's take a look at the calculator to see how that works. So we're here on the representation of a $300,000 salary tab with $125,000 out of pocket and a $125,000 seller note. You can acquire a business for $2.3 million that kicks off $650,000 in profit a year. Now we're getting into some real money. After your debt service on this one, you're looking at a cash flow of about $300,000 in your pocket at the end of each year while you're paying the debt service. And of course, as soon as that debt service is paid off, your salary, your SDE, your profits from that business jump to $650,000 a year if the business doesn't even grow during that time. And most businesses grow over time. So these larger businesses include staff with actual experience. They include processes and standard operating procedures, customer relationships. They have years of historical data, and you step in as an owner, not an employee. You compare that to a $100,000 content site that has fragile traffic, short-term trends, algo risks. It's just such a much better business. Scale means stability, diversification, and survivability, which is why high-income earners target larger deals, because they're buying stability and not the chaos we see with these tiny acquisitions. Now let's talk about a couple of the things that everyone worries about when they're buying companies, and that's failure and timing. Fear usually comes from imagining you're doing this alone, but most deals use seller financing, which means the seller finances part of the deal for you. And when a seller shares in the risk, the deal becomes safer, not harder. Their money depends on your success, and that aligns incentives. And if failure is fear number 1, timing is often fear number 2. Every year you wait to buy a business is a year of capped income and zero equity. Businesses appreciate faster than your savings account, and a $500,000 business today might be worth $600,000 or $650,000 next year. Inflation eats your savings, higher interest rates shrink affordability, doing nothing becomes the most expensive choice. So let me show you what your life could look like once you're on the other side of this acquisition decision. Your day starts at 9 or 10 a.m. You open up your dashboard and revenue is up 8%. Customer issues have already been handled by your operations manager because you're buying a $500,000 plus business. You approve a few expenses, and then by noon you're done. Whether you want to work 2 hours or 20 hours, the business keeps running independently. You replace your salary and you own the asset that pays you. And that leads us to the identity shift that every single buyer faces. Right? The math is clear, the structures are proven, the path is visible, and the only real question is, do you keep waiting or do you act now? Successful buyers aren't the richest people in the world, they're the ones who take the first step. So here's your first step if you want to see exactly what you can afford. Go download the affordability calculator I showed you. It's linked below. Plug in your numbers and see exactly what size business you can afford right now. Not someday, not after you save for years, but today. And if you're serious about buying a business in the next 6 to 12 months, join me inside the Digital Acquisition Club. You'll get the same checklist, lender network, deal reviews, everything I have at my fingertips that I use for my own acquisitions, you will have at your fingertips for your acquisitions. Hope to see you soon.